Now let's turn to how relaxing those COVID-19 policies are set to affect the Chinese economy. For a macro view, let's bring in Ben Emons, Senior Portfolio Manager and Head of Fixed Income and Macro Strategy at NewEdge Wealth. Thank you for joining me this morning. So first, I know we want to talk about this distinction between opening up and reopening so we can really get an understanding of the path that China's on.
Indeed, and good morning. Thank you for having us. There is a difference between reopening and opening up because reopening is just like what we've experienced. So as you were highlighting in the previous segment, you're seeing a major outbreak happening. That's really because of the economy is starting to reopen. As you relax all those restrictions, then you could expect a major wave coming through now, but it's not going to set back the economy near term. They want production to come back up. The data that come out later this week will show a big depression in production, so that has to be renormalized, same as retail sales. That's reopening. That's, I don't think, any different from what we have experienced in the United States or in Europe or elsewhere. I will actually expect that the Chinese consumers will probably behave similarly as what we did. You go out there and relive your life and spend, but the opening up of the economy is about foreign investment coming into China. And with everything that China has always guarded so much about its economy, and limited foreign investment to an extent, it's an interesting dynamic to see the reopening of the economy while the Chinese policymakers start to re-emphasize that they want to open up their economy for longer-term structural investments. If that both happens at the same time, that's a major, major macro event in my view for the next few years.
Certainly, if they're both happening at the same time. And we know that China has been reevaluating some of its strategic partnerships. We saw Reuters reporting that President Xi said he's looking to buy oil and gas in yuan during his trip to Saudi Arabia, really shoring up Beijing's position, wanting to have the renminbi be more widely used as a global currency and chip away at the dollar's dominance. What sort of impact do you see that having?
This is important because, China has been doing this on and off, this policy of internationalizing the yuan since 2009. And one thing that has never happened is this pending deal. The Chinese authorities overnight said that they hadn't finalized it yet, but so that means it's coming. This pending deal about settling crude oil into yuan. In other words, everything that China starts importing as it reopens its economy, it will be then settled in yuan. And why that's important is, well, yes, it's a move away from dollars. It's a move away from the reliance on dollars. But it's also about basically the ability for China to strike a deal with Saudi Arabia, really geared towards its economy and not being dependent on any other country, including the United States, for energy imports. I think that's key for the Chinese economy itself. It puts, of course, let's say, a bid on their crude oil over the future in the near future, meaning crude prices may not decline so much anymore from here as a result of that type of settlement, that type of deal. So another development alongside of the reopening and the discussion about opening up its economy.
I mean, the pressure does really seem to be on not just politically, but economically for China with this reopening. What do you think is going to make or break this reopening and opening up?
Well, I think what you could see is that as the reopening continues, it seems that we really have moved now away from zero COVID. That's more and more confirmed. The challenge will still be to get an economy opened, just like our economy is in Europe, an open economy, trading and allowing for foreign investments to come in. And, basically what we've experienced, and I think that's still, several steps to see a fully reopened economy from China in that respect. The reopening itself, however, is really about a major boost of foreign travel, major boost to the region in Asia. You can tell from Hong Kong, the Hong Kong index is now up almost 35% since October when the first reopening discussion started. And Hong Kong GDP is likely going to be boosted a lot. So those effects are there. I think the opening up is a second stage. But as we know from Belt Road initiatives and how that has actually morphed into a big financing globally, over $1 trillion, I do think that this opening up of the economy comes at a very timely point here as they reopen the economy. So expect China GDP to really start being boosted into next year back to 5%.
And Ben, I know that you also take a look at China's PPI as a gauge of sort of global deflation and inflation. What are the signals that it's telling you right now? What could that mean for the US economy?
That too could be meaningful because, if I take it back, say, 5-6 years ago, when you had also the China PPI in deflation, and you had oil prices really low, sort of a $20-40 per barrel range, that put a lot of downward pressure on CPI in the US and Europe for quite some time, at least for several years. And that's completely the opposite today. China PPI is needing deflation because of the restrictions. That's all being eased. And they're having this energy demand. On top of that, oil prices are on average at least $40 to $50 a barrel higher than from that time. So the impact on our CPI in the future, not tomorrow's report, but in say the next number of months, could be significantly again, that energy prices are going to go up and that expectation of inflation is going to rise again. So it's something to really watch, because as Xi Jinping negotiates this deal in Riyadh to settle oil in yuan and start importing more and more oil from Saudi Arabia, reopening the economy, at the same time, the PPI data in China will start to reflate, as we say. It comes out of deflation territory into positive territory. That will actually impact global PPI. So, and that's food, that's energy, that's commodity demand. So it's something to really watch for, as we have so much benign expectations in the market currently about slowing down of inflation next year, and particularly in 2023.
Certainly a data point we have to keep an eye on. As we look at the whole picture, a big thank you to Ben Emons, their Senior Portfolio Manager and Head of Fixed Income and Macro Strategy at NewEdge Wealth. Thank you so much.